Monday, November 21st, 2022, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at the U.S. Treasury market, or the U.S. government bond market, and how liquidity in that market is showing signs of trouble, not just for the U.S. Treasury market, but the whole world's financial system. I just like to say that if you enjoy my videos, make sure you hit that like button. And if you enjoy my videos regularly, make sure you also subscribe and hit that little notification bell to be notified of all my new videos. I make a lot of videos. Well, I make at least one a day, basically one a day. So now to the U.S. Treasury market and the question of liquidity. And this problem has been around for many years, not just since 2020, but it is a problem that usually comes up during some financial crises. But it's getting worse in terms of the liquidity is getting worse and worse for U.S. Treasuries, and that's a problem because U.S. Treasuries are supposed to be where you place your funds. I listened to Pierre Lassonde the other day and agree with him on many things, but he said that there's no substitute for the dollar. He said someone who's got billions can just park those billions in dollars very safely and without a problem. And usually when someone parks billions, it's in these treasury securities, bills, notes, and bonds. And the fact that they're having problem with liquidity is not very good. And I think that is starting to show cracks, especially if you look at John Exter's inverted pyramid. And we know what's at the bottom of the pyramid, what supports the pyramid. Well, it's gold and silver to some extent, but I would say it's more gold. So that's why it's so important to have physical gold and not paper gold, because paper gold gives you exposure to counterparty risk. And you can bet that when these financial institutions that sell you the paper gold, when they get into trouble, they will not fulfill their promise to give you gold or whatever. So recently there's been a lot of talk about Treasury liquidity. There's an article from October 6th. I know it's over a month. But it says on Bloomberg, Treasury's liquidity problem exposes Fed biggest nightmare. JP Morgan measure of Treasury market depth continue to plunge. Bloomberg's gauge of how far yields are from fair value rising. So they give you this chart here as well. U.S. government securities liquidity index. And I'm going to try to explain to you what this means, because they don't really give you on this Bloomberg chart what it means. But I think I found what it means. If you go to a paper by someone called Michael J. Fleming, he wrote a paper on this, measuring Treasury market liquidity, back in September 2003. For the Federal Reserve Bank of New York. And why is the Federal Reserve Bank of New York so important? Well, that's because this is where they trade treasuries for, be it for QE or QT or for open market operations. They are the center of it, and they have primary dealers, people like JP Morgan and other banks. They can even be brokers like BGC or Cantor Fitzgerald, and we're going to come to Cantor Fitzgerald in a minute. So the New York Fed is right at the heart of the Treasury market. So this was written in 2003. So this is what it says here of why Treasury market liquidity is so important. Under background, it says the vast liquidity of treasuries makes the securities important for a range of market-related trading and analytical activities. For example, because market participants can buy and sell the issues quickly with low transaction costs, they use treasuries to hedge positions in other fixed income securities and to speculate on interest rates. High volume of trading and narrow bid and ask spreads also make treasury rates reliable reference rates for pricing and analyzing other securities. So you've probably heard that treasuries are the risk-free security, and that the risk-free rate is used to price other securities. So this is what this means. And I'm not going to read the whole paper, even though I have. It's not very long. You might want to read it. Very technical. So this is his conclusion of the best way to look at liquidity. And he says the bid and ask spread. So what's the bid and ask spread? Well, let's say a foreign central bank goes to JP Morgan and says, I want to sell 100 million 10-year notes on the run. The one that's the last issue that's trading the secondary market. Well, JP Morgan will say, well, it's 102.16 bid at 16 and a half. And what's the 16? Well, that's a fraction of a 32nd. Yes, U.S. Treasuries are not traded in decimals. They're traded in fractions of a 32nd. So that bid and offer spread is half a 32nd, 16 bid at 16 and a half. So the central bank will say, well, okay, I'll sell you 100 million at 16. JP Morgan say, fine. That's how it should work. So, and he says, and price impact coefficient, middle chart, correlate with episodes of reported poor liquidity in the U.S. Treasury market. The prominent spikes in these two measures coincide with the volatility spikes, bottom charts. Volatility is something different, of course, not the best way to measure liquidity. Associated with the equity market declines of October 97, the financial market turmoil of October 1998, I think that was when LTCM and the Asian crisis came to the fore, and the Treasury's quarterly refunding announcement in February 2000. So we'll focus here on the bid and ask spread, because I think this is what Bloomberg is showing now. So bid and ask spread of U.S. Treasury notes, as you can see, 30 seconds of a point. So in the late 90s there and early 2000, you can see that the 10-year Treasury, the bid and ask was less than a 30 seconds. But you can see that that bid and offer spread widened during the crisis, and it went above 1.25. The conclusion of this paper is that the bid and ask spread is the best way to look at it. So if we go back to this Bloomberg article from October 6th, you can see that in 2020, March 2020, the spread was 30 seconds, as you can see, more than just above 30 seconds. Then everything got back down to more normal, late 2020, 21. It was actually around 3/4 of a 30-second the bid and ask, just like it was in the 90s, but it's been rising ever since, and we're not supposed to be in a crisis, right? And right now, we're almost back up to 3, which is a lot more than it was in the 90s. Those crises, you saw that it was 1.25 of a 30-second. So I don't have an updated measure of this, but suffice it to say, I don't think that's come down. And even publications like the FT are talking about this. And this article was from October 20th. The market in treasuries is storing up trouble. Questions raised by policymakers are a sign of mounting unease about American government bonds. So, no disrespect to Mr. Lassonde. I'm not too sure if the dollar is safe as people say it is, the dollar system, and the Treasury Treasury market is really the dollar system. And a little bit on trading treasuries, because when I was hired by Cantor Fitzgerald, actually, in 1992, because I started out in Switzerland. I worked there for a small private bank for 3 years, and I was hired by Cantor in London to work at a desk where we traded for people like central banks and big institutions. Well, I think it was one central bank, and we traded with some monetary authorities as well. But I remember one of the banks we dealt for was the Negara Bank Negara, which is the central bank of Malaysia. So I'm very familiar with trading treasuries with 30 seconds and stuff. And I remember well that our commission for trading treasuries was 1/8 of a 30-second. And 1/32, of course, on a million, because we traded in millions. Let's say someone had a bond and the face value was $1 million. He sold $1 million, but these central banks, they could do 10 million, 25, even more. Of course, Bank Negara wasn't my client. I started there helping the brokers and the traders. Well, they weren't really traders. We broked, but eventually I got some clients as well. But just to give you an idea, 1/8 of 1/32 on a million face value bond, or 10-year, let's say, is $39.06. So if you did a 10 million trade, your commission would be $390.62, and that's how it worked. The 30 seconds. So I suspect now brokers in the treasury market, seeing that the bid and offer spread is now like almost 30 seconds, they're probably making a little more commission. They're probably charging half of a 30 second, not 1/8. Gilts used to be traded in 30 seconds, but they changed it to decimals. So yes, I think it's serious. I don't know how it's going to play out, a potential crisis, but the fact that the treasury market is in trouble is not surprising, because I think the gilt market was just a foretaste of what could come. Usually a lot of what happens in the UK happens in the US, and sometimes vice versa. So there you go. That's what I wanted to talk about today. So let's quickly look at where the markets are now. It's 20 to 9 a.m. London time. We've got spot gold down just about $10, a little less than $10, 1741. High's been 53, and we're right near the lows here. Am I concerned? No. I really want to have a piece of Exter's pyramid, the bottom of the pyramid, not anything above it for now. So yeah, we're down about 0.5%. Silver is down 18 cents at 20.76. High's been 21.05, low 20.66. So it's going to be a short week in the U.S. and really for the whole world because of Thanksgiving. But I would say the key level for silver would be that we get back above 22. We went up there a couple of times last week, but there's a lot of resistance, so we'll have to keep an eye on that. The Dow futures is down 95 points. The NASDAQ 100 future is down 35, and the S&P is down 13, or 1/3%. To the currencies, sterling or cable is down 0.5%, 118.22. The euro is down about the same, 102.58. The dollar is up 0.5% versus the yen, 141.07. The Swiss franc or the dollar is up 1/8 versus the Swiss franc, 95.56. And the dollar is up 0.5% versus the yuan at 716.61. So it looks like the dollar strengthening a little bit, and it's weighing on precious metals. Let's go straight to the commodities. We won't cover the other currencies because we're going on for a while. So WTI crude is down below 80 now. It's a 79.57, down 2/3%. Brent is down about 3/4 at 86.60. High grade copper is down 0.5%. At 362.50. US nat gas is unchanged at 660. And let's check the European nat gas futures. Well, that's up 3.6%. We're back to like 120 now. And let's look at the Treasury market, see what we're doing this morning. US Treasury today, quickly. Yeah, the 10-year yield is down 1 basis point at 380, but the 2-year yield is up 1.5 at 452. So that curve inversion as well doesn't bode well for everything, for the economy. It's a bad sign. Even the 1 month bill yield is up 4 basis points at 390. So the 1 month to the 10-year is inverted by 10 basis points. And that's not a good thing either. So we're going to keep an eye on everything, of course. And if you enjoyed this video, make sure you hit the like button. Please share it far and wide. And think about subscribing to the channel as well if you haven't. And with that, I wish you all a great day. Take care. Bye.